Hello, welcome everyone to another bloody day on the markets for the portfolio. This is a Q4 Q&A session. I do these every quarter. If you've not attended one of these before, then basically the way it works is there's a post on eToro which you can go and ask a question in. I will shortly refresh it, and then any questions after that point I won't answer during the stream. And then after I've finished answering the questions from that topic, I will answer questions from chat. Pretty much nothing really is off limits as long as it's somewhat sensible and related to investing, I guess, or I guess there can be questions about getting to know me a bit more or my strategy and things like that. It doesn't really have to be related to the Q4 or Q1. It can be about markets generally, or about my outlook for 2022, or 5 years down the road, or anything like that. So pretty flexible on what kind of questions you can ask. Before I start answering questions and stuff, obviously I want to point out that this is obviously a live streamed event. So if you're watching on YouTube, any questions that you try and type into the comments probably won't be answered. And obviously none of this constitutes any sort of financial advice. I'm streaming to a broad audience, and this will be distributed on YouTube afterwards. So obviously none of this is personalized to your individual circumstances or anything like that. So yeah, just sharing my opinions on the markets and answering some questions. So with that said and done, I'm going to share my main screen of the eToro page, and I can start answering some questions. Okay. I'm just going to refresh it now. So anything asked after this point, I probably will not answer unless I get really desperate near the end. Let's begin, I guess. Elephant in the room is a political crisis. Yeah. So yeah, save your questions in chat until after I've answered the ones on here first. And yeah, I'll try and do my best to answer everyone's questions. We'll see how long we stream for, but obviously it depends on how many questions there are. So the first question is, what do you think of Amazon Overstock? Some PIs are very bullish on them. Overstock actually just had their earnings pre-market, or was it after-market last night maybe? And yeah, they actually, I mean, their numbers are actually pretty bad overall. Kind of negative numbers across the board, pretty much. But the stock is up something like 20% or so today, pretty much based off of the news with ICE. So the owners of the New York Stock Exchange and such. So they've got a new CEO for their T0 product, which is kind of a crypto exchange type product, and they list kind of almost crypto based stocks and stuff. It's well, the clue's in the name, T0, right? So supposedly the settlement is significantly faster than traditional stock exchanges and stuff, and that's kind of what they built. So yeah, that project started a long time ago, and a lot of popular investors, including myself, have invested in Overstock over the years based off of the kind of hype around that product. It's never really delivered, though, to be honest. And yeah, I think people are pretty optimistic about the new CEO and the new funding that they just secured for it. So I think that's probably why that rallied based off of this earnings. But generally, Overstock's still down pretty heavily for the year, I think 20 or 30% or so still, even after that move back up. So it's still not a great position to be in at the moment, I don't think. Like most of the other small caps, it seems to be getting punished, despite being a reasonable company. But for me, what the reason that I'm not really bullish on that is the actual underlying business. I think that facing increasing competition. They're a bit late to shift towards ESG. They just started a new ESG report. And yeah, I think they're a little bit late in that space to move in that direction compared to some of their competitors. And I think some of the other competitors like Wayfair, for example, and obviously Lovesac, which I'm invested in, offer better growth trajectory personally. But I can see the argument for investing in it based off of T0, but for me, I think probably I'd prefer to see management just split out that into a separate IPO or something, and then maybe I would invest in it. On Amazon, Amazon have done really, really well recently as well. But for me, with Amazon, it comes down to the ethics of it. The company has improved quite a lot recently, but I still feel like they're somewhat on my kind of grey list in terms of investing in them. I think that there's still a lot of work they need to do on their policies around environmental damage and on staff welfare side of things. So yeah, in terms of the actual stocks though, yeah, I mean I can see the argument for being bullish on both. I think Amazon is probably the one that I would pick if I had to pick out of the two, and if I wasn't concerned about the ethics. But for the moment, I'm not invested in either and don't plan to be. Another question from the same person. Asking about what my 3 highest conviction stocks are. I remember last year Canadian Solar was on your list. What has changed about it? Canadian Solar wasn't on my list last year. In fact, I think early 2020 is the last time I held any Canadian Solar. I got rid of that a while ago. And primarily the reasoning for that was that there was kind of a move away from the kind of grid scale solar projects in the West generally, and North America at the time. And on top of that, we then had COVID, which was really the nail in the coffin. Canadian Solar produces pretty much everything in China. Very, very Chinese kind of focused company, and very related to Chinese markets, and very sensitive to the Chinese markets. And so, yeah, for me, it wasn't worth it because of that. And I went down the route of some of the home installers instead, and some of the panels that are more geared towards those markets as well. Another question from the same person. 3 questions. Wow, he's going for it. He got them in early though. So, how will the invasion of Ukraine affect your portfolio? Well, that is a big question, and although it doesn't have, well, actually, it does have a lot of upvotes on here, so I guess I can spend quite a lot of time on it. Where to start? Yeah, the situation with the Ukraine is obviously pretty complex in terms of how it impacts markets. We've seen Europe kind of roll over a bit in the past few days. The US today, or yesterday, I think, announced some reasonably weak sanctions, in my opinion, and in I think the market's opinion actually as well. And I think that actually creates more uncertainty in many ways because the market kind of knows that there's more to come. In reality, if Russia keeps escalating the situation, then obviously there's going to be more sanctions to come, and those sanctions also affect US markets as well as Russian markets. In Europe, obviously the gas and oil situation is, especially gas, is the main kind of thing that everyone's watching. And so, yeah, anything anything that really is, well, I mean, it affects everything at the end of the day. Pretty much everything in Europe is affected because all of these businesses rely on fossil fuels in some form in order to operate, whether that's for their logistics and supply chain stuff, or if they're actually utilizing I don't know, carbon intensive raw materials or products that are being imported from elsewhere. I mean, like, when the price of oil and gas goes up, then the cost of producing anything goes up. So really, only the kind of web services and tech side of things are the ones that are likely to be somewhat immune from it. But I mean, it's still going to impact the economy overall. And that's just from the gas side. On obviously, you've got the sanctions and things on top of that. So that's freezing accounts of Russians and of different businesses and stuff, or limiting their access to certain markets. The result can be that perhaps a lot of people start moving money out of those markets. People are also moving money out of the Russian markets. That's been hit pretty hard in the past week or so as well. So all of these things are related, and then of course the other thing is that you can have companies that are somewhat based in Russia, and maybe they have a Russian branch, or they rely on Russia in their supply chain for their goods and services as well, or the Ukraine. Can't forget the Ukraine in this as well. So I mean, there's a huge amount of moving parts. So it's kind of impossible to say how it's going to affect your portfolio in a really kind of accurate way, but I think it's pretty clear that it's going to be negative in how it affects it. But I guess the other thing to mention is that in reality, a lot of markets, including the US, aren't really that dependent on trade with Russia. So it shouldn't be quite such a big deal unless there's real kind of troops on the ground kind of stuff taking place, in which case the markets may get a bit more nervous. But even then, I think really the nerves surrounding that are more with the backdrop of how China are acting at the same time. So it's not so much that these markets are really concerned that the war's going to be dragged out and take a long time if there is a war, which hopefully there's not. It's more that they're concerned about the implications for relations with China and stuff as well, and how China kind of reacts to the situation. I think because really, while the West can, I think, pretty comfortably afford to defend the Ukraine if they want to, without causing too much economic damage to themselves. Really, it then weakens their position for negotiating with China and with other world powers, whoever that may be. And so it does put them in a kind of disadvantaged situation on the world stage a bit, in terms of deploying resources effectively and kind of managing their economy and making the most out of their growth opportunities. So I guess that's kind of a non-answer, but I think a lot of it has been priced in, to be honest. Like especially with what's happened recently with the Ukraine kind of declaring the state of emergency and stuff for 30 days and all of this side of things. I think the market is really kind of pricing that in today, and they priced a lot of it in prior to that already. And I think really when you actually look at where markets are, they're pretty they're on pretty strong support levels, I think. So I think it's reasonably unlikely that that we drop that much further from here, unless Putin really does escalate things in a kind of strange direction. To be honest, I'm not sure that we're going to see kind of full scale invasion or anything like that. I really think it's more a case of recognizing the separatists and then trying to sort of claim that as part of Russia or an independent state that will later become part of Russia, and arguing that they're defending that rather than invading, and stuff like that. It's it's a weird situation for sure. Yeah, it's a really weird situation, but I just don't see them really actually going ahead with this, and calling Europe's bluff. Why do I always stream on red days? I don't know. It's becoming a bit of a tradition, isn't it? Thanks for everything. Appreciate your efforts. Is this a good time to start considering short selling? Yeah, so that's another good question, I guess. In hindsight, definitely yes. I did say when we kind of had this bounce in markets, I guess it was towards the end of January, that this could be a dead cat bounce and we could sink lower. Like we've still got all of that inflation, the interest rate hikes in the US to come, and seeing how that impacts inflation in the US and similar in Europe. Europe hasn't really moved too much on this. The UK and a few other countries have, but again, they've also still got more rate hikes to come, I think. So that there is an argument to be short, but I think right now is certainly not the time to start. realistically, I think it's much better to kind of wait another week or so, see how the situation with Russia kind of pans out, see how this support level in the markets holds out throughout the week, and then kind of make a decision from there about if we want to start opening more hedging positions again. Really, it's too late to open a hedge here. If anything, I would be more tempted to open some long positions on the markets here, and kind of bet that the market is going to bounce a little bit from this area. Still holding here for the long term through the crisis. I would like to hear your thoughts on BIP and BAM, so Brookfield Infrastructure and Brookfield Asset Management. I don't really know much about the asset management. I mean, I don't really know that much about either of them, but I know that Brookfield Infrastructure is basically gas pipelines in Canada and North America, I think. I'm not sure about the asset management side of things, but either way, they're not really companies that I really investigate too much. Obviously, I try and avoid investing in anything fossil fuel related and weapons related, and to some extent gambling, all of those, tobacco, all of that kind of stuff. Anything that I think really is not really producing a net benefit to the world, I try to steer clear of. And obviously, that's a pretty kind of a grey area. You can argue about where does that end and where does the good stuff start. And I argue with myself about that quite a lot. But these are companies that probably I would never really consider investing in. So I don't think there's really anything that I can share on it that would help you, to be honest. I've not investigated them in any meaningful way. Speaking of which, next question. I know you don't invest in military or non-renewables, but what other opportunities do you see from the Ukraine war now that it has started? Well, it hasn't started really. How will a war economy affect inflation, interest rates, fiscal tightening? Do you think now is the time to buy growth stocks at discount, or did we not see the bottom yet? Okay, so there's kind of a few questions in here. So 3 questions really. So the first is what other opportunities are there? I think there's you could argue that there's some good opportunities in the mining sector, for example. The Ukraine's pretty well known for iron ore and steel exports and things like that. So potentially elsewhere there could be opportunities to invest in other regions that are producing those goods. If you are so inclined. Again, it's not really an area that I focus on that much, but certainly, there's a case for investing in those kind of companies. Outside of that, I don't think there's that much really. Renewables do make sense in this context, because if they do cut off gas supplies to Europe, then it's inevitable that Europe will be looking for energy from elsewhere, and one of the other places they can get it from is renewables. It's unlikely to really affect the stuff that's kind of in the planning phases, and the people who are producing wind turbines and such, unless this kind of drags out and it turns into subsidies or something like that, to try and grow that industry and ramp up how quickly they can bring new renewables online. More likely is that you'll see increased valuations for companies that are producing electricity, for example, from renewables that are already online, or even non-renewables as well. So I guess in some ways I do have a bit of exposure to that with Trig and SSE in my portfolio. So Trig basically owns a bunch of different renewables, mainly in the UK, Spain, Sweden, Denmark. Those are where they own them mainly, and so they benefit from the increasing price of electricity somewhat, although most of the price is kind of fixed in futures contracts. And SSE, again, one of the biggest providers in the UK. They produce from not just renewables, but a bunch of other stuff as well, although they are one of the biggest renewables investors in the UK. How will the economy affect inflation, interest rates, fiscal tightening? How will a war economy, sorry. That's a good question. I mean, realistically, it's going to involve more spending. Deploying military or responding to the threat, even by sending equipment or whatever it may be, is going to cost money. And I suspect that most of that is going to be coming from probably, in terms of like relative to the GDP and such. I think a lot of it's going to be coming from the UK. Actually, they seem to be one of the more vocal kind of defenders of the Ukraine at the moment. But obviously, the eurozone will also be affected, and so will the US, because it's likely that if any of these three groups, three parties, support the Ukraine, then all three of them will. So yeah, you're likely to see increased spending, which kind of goes against the interest rate hikes to some extent. Normally, you would ramp down money printing and spending at least a little bit before you start increasing rates, and as you start ramping up rates, it means that we'll probably see inflation rise further, because not only is there that kind of situation going on within those countries' economies, but again, supply chains will be disrupted, especially around Ukraine and obviously Russia. Uh, Things like electricity prices will obviously be increasing, so that'll make a significant dent on inflation. Whether or not that changes, the basket of goods that they use for measuring inflation is, remains to be seen. But you can be pretty sure that inflation is going to go up, and if inflation goes up, then it's more likely that we'll see governments start considering cutting back elsewhere in their budgets to try and kind of even out that situation a little bit, and we may see interest rate hikes come a little bit faster to kind of counter that inflation threat. And the last question from Maximilian is: Do you think now is a time to buy growth stocks at discount, or did we see the bottom yet? It's very hard to say whether or not we've seen the bottom, but I do think that growth stocks are at a significant discount, especially in the small cap kind of arena. I saw a tweet today from one of eToro's new analysts over in the US talking about this, and a 7-week losing streak for the IWM is. It's not unprecedented, but I think the last time we had it was in 2014, and before that was 2008. So this is the longest losing streak it's had in a pretty long time. And if it goes another week or so, then it's going to be up there for being the worst losing streak in my lifetime for that market. And I think when you actually kind of examine that market, there's a lot of really, really good deals to be had in there. A lot of companies that are cash flow positive. They have a perfectly healthy balance sheet, enough money to keep them going. Some of them are even paying out dividends. They're so healthy, and increasing their dividends. And they're in growth markets on top of that. So, there's definitely bargains to be had out there. But I think that there are obviously some companies that are much more sensitive to interest rates, especially. And so, yeah, again, they're going to be hurt again the most by what's going on, especially because they're a small cap, right? So there's less liquidity, so the price is more volatile. There's less analysts kind of looking at it. The quality of the financials and things that they put out, and their guidance is usually a little bit lower as well. So all of these things kind of play a role. So yeah, I would expect them to continue to suffer, sadly, at least in the short term for a few more weeks. But at the same time, they've already suffered so much that I think the valuations are starting to get to to levels that really they can't fall much further for some of those companies. And I think anyone who's investing time in actually investigating all of those companies and on individual basis is probably going to do quite well. So I've got quite a lot of exposure to small caps at the moment, and yeah, to be honest, I'm really, really bullish on them. It's really painful watching it continue falling, but I think there's limited time left on those falling. For the bigger growth stocks, it's hard to say, to be honest. Valuations are still quite high, but the earnings that we just have from the likes of Microsoft, Google, and Amazon, for example, and well, the FANG stocks generally, I guess, unless excluding Facebook and Netflix, I guess, have been really good. So, to some extent, they're justifying those higher valuations. Which sort of fundamental analysis do you perform prior to entering into a new investment? Could you comment on how you calculate the intrinsic value of a stock? Yeah, I don't really, to be honest. I mean, I have sometimes used discounted cash flow modeling. It's more relevant for certain types of business than others, but because I'm generally much more growth orientated, I tend not to focus on that quite so much. I much prefer looking at the narrative of the market that they're in and the growth trajectories for those markets, and their kind of product mix that they have, and any kind of patents or moat that they really have for the business. So, for example, you could argue that it's worth doing intrinsic evaluations on things like rail companies in the US, which I'm invested in, like CSX and Union Pacific. And I do look at other people's. To be fair, I do look through some of the valuations people have come up with on Seeking Alpha and such, based around the dividend yields and things like that. But really, for me, it's about what's the future of this industry looking like, and what's the growth rate. Because if the market is underestimating the growth rate, then and it's in an industry like that where everyone's already doing a discounted cash flow of some sort, to come up with an intrinsic valuation, then you can be pretty sure that if they've got even if they've got one of those kind of key elements that you put into that wrong, then you can kind of find that, and they've underestimated one of them, then that it's going to be a good investment. And so I think when you look at things around like some of the dividend yields and the cash flow and projections and things, people are usually pretty accurate on that sort of thing. But in terms of like growth of markets and cost savings from more disruptive technologies, that's where analysts tend to fall short a bit. And I think that's where my advantage is in those kind of stocks. And then for growth stocks, I mean, to be honest, I think it's somewhat of a pointless exercise. The markets move so quickly and the news changes so quickly. It's like crypto, innovation is happening on a monthly basis, and so you would have to be updating your valuations on a monthly basis, pretty much, or trying to account for all of that. And I just don't think that's really feasible in the way that most of these models work. Certainly not if you're an individual like me. So I think it's kind of a bit of a waste of time going that route for the kind of investing style that I have. But obviously, that being said, I do look at other people's, because if they've done the work for me and they're publishing it, and I can read through it and kind of be critical about what they've considered and what they haven't considered, then I think again that can work out pretty well. So yeah, I wouldn't really describe myself as a value investor in that way. Why is the translate? Okay, the translate button does work. Welcome to Rome. My profile picture on Twitch is indeed me in Rome, and it was really nice when I went there, but I'm not there now. Hi Jay, I'm a value investor outside eToro, so I'm happy to diversify investing with you. You buy things I would never buy myself and which I do not understand, but I understand your method and the logic behind your decisions. What I do not understand is why you think of all things NFT have value. What is the value of having your name on a ledger, but no copyright or any other deal rights or something? What is it that I'm not getting? Okay, so I'm actually not really that bullish on NFTs. I'm quite critical of the majority of NFTs, in fact. So this is kind of an interesting question, I guess. NFTs ultimately really is essentially just a link in a blockchain to something. It can be to an image, it can be to a video, it can be to a contract, it can be anything. And so really it's just a kind of a ledger storing proof of your ownership of something. Now, how enforceable that ownership is another question, and this is why I'm cautious around a lot of NFT projects. Likewise, I think valuations for a lot of NFT projects are somewhat crazy because these are incredibly illiquid markets that are very easily manipulable as a result of that. If there is only one unique version of a Bored Ape, and you try and build a market around that, at the end of the day, the price is decided by the seller and nobody else really. As long as there is at least two bidders, uh, you know, uh, and there's always going to be more buyers than sellers when these things are appreciating a lot. Then really the seller is the person who controls the price, and not only that, but because of the kind of somewhat unregulated and decentralized nature of crypto, you can have situations where someone buys something from themselves with another account purely to kind of manipulate the price and make it appear as though the value of these things are increasing. So I'm incredibly cautious around those things. On top of that, a lot of them are not remotely decentralized. As I said, right, it's basic. Most of the time, the metadata for these things is just a link to an asset that's stored somewhere else. It's not actually stored on the blockchain. It's not actually stored in a decentralized way. But some of them are. Some of them are either stored on the blockchain, or they are stored on another blockchain, or on some other form of decentralized or very well governed kind of storage system, like IPFS or something like that. And in those cases, there is a bit more kind of, I guess, intrinsic value behind how those work. So yeah, for those projects separately, I guess you can argue that there's a good reason to be bullish on them, right? There is genuine proof of ownership of something. That the thing that is linked can't be changed or controlled or taken away by someone else if it's stored in a decentralized way. And in many cases, I mean, you mentioned here that there aren't any real rights. That's not the case. You can have real rights. You can have distribution rights or some sort of licensing agreement. You can have all sorts of things tied to these assets. There's nothing stopping you from attaching different rights to the assets that you're buying as an NFT. So, for example, you could have an NFT of I guess me, for example, right? I could make an NFT of myself, and I could attach to it the right to have a 30-minute private call with me every quarter, right? And to some people, I guess maybe maybe that would be valuable. It's probably a bad example using myself, but maybe that would be valuable for some people. And if I give those rights, and there's a proper written contract, and it's provable that I've given that, and it's stored in a decentralized way, and it's not able to be modified or changed in any way by anyone else, then yeah, that's essentially that's kind of falls under contract law to some extent, and or you could argue, and obviously that has value, and you can do the same things for all sorts of different types of rights. So that really is the part of NFTs that interests me the most. Really is NFTs that actually give you more than just a piece of art or a piece of music or something, but actually come with different rights associated with that. It could be commercial rights to kind of use the imagery, or it could be I don't know, all sorts of things. And then I guess the last thing is the kind of membership of clubs, right? Which is I guess the next thing. It's these are kind of like exclusive member clubs, really, and you could consider the NFTs that you're buying for a Bored Ape, for example, or a CryptoPunk as membership into that elite group, and part of being in that group and proving that you're in that group with your NFT is that you then have access to everyone else in that group, and it's like a kind of private network, I guess. So yeah, those are really, I guess, the things that can kind of underline the value of these things, but it's massively speculative at the moment. I don't own currently any NFTs, and I've never bought one. I mean, maybe someone sent me one to one of my wallets somewhere, but as far as I'm aware, I don't own any. So yeah, I wouldn't say that I'm bullish. I wouldn't say that I'm bearish either. I'm kind of neutral, and waiting for good projects to be built on the technology. That was probably a longer answer than that question kind of warranted to some extent, but I think it's quite interesting to talk about. I will get round to answering questions in chat, by the way. I promise. I promise I'll get there. Okay, what are your plans for the portfolio in light of the war in Ukraine? What effect do you think the cancellation of Nord Stream 2 pipeline will have, specifically on green energy positions in your portfolio? Thanks for your work. So we kind of touched on this earlier when I was responding to the question from Maximilian. So if you're watching this and you've skipped ahead to try and find this question, maybe skip back a bit and find his question first if you're on YouTube. But we're not on YouTube at the moment, we're on Twitch. So I guess I'll try and highlight some of the kind of more specifics of this question, since they are really overlapping in a lot of ways. Yeah, the cancellation of the pipeline is obviously a pretty big effect. Ultimately, it's going to affect countries like Germany the most, and actually countries like France, for example, are going to be a pretty big benefiter from this, since they run something like 90% or so off nuclear and renewables. Yeah, I mean, that's it really. And the same thing goes for my green positions in my portfolio. A lot of them are in things like Solar Edge and Enphase and Sunrun, VWS, companies like that, which are producing an inverter or a solar panel or a wind turbine. They're not really going to be that affected ultimately, because it's not like all of a sudden everyone's going to go out and order new wind turbines and solar panels immediately. And even if they do, a lot of these companies are pretty close to capacity in terms of producing them anyway. We have high cost for raw materials. Semiconductor shortage is affecting a lot of it in the solar side of things, especially. So, it's not really going to help those companies that much. It's always good to have more demand, I guess, but if they can't actually meet that demand, then it's not really helping their bottom line at the end of the day. So for them, it's not really going to make much difference. As I said earlier, it's really about the people who already have ownership, the people who are owning and operating these facilities already. Those are the guys that are going to benefit the most, and perhaps some of the service providers as well. So the likes of VWS and Ørsted and things often provide support services. I know Siemens Gamsa Renewables do a lot of support services for wind turbines and things. So, I guess those sectors of those companies will benefit, but really it's probably pretty minor in the grand scheme of things. Let's see. I think that stocks, both value and growth, will be hit even harder, especially when people are cutting down on expenses, luxuries, and with what is going on, many anticipate that worst is yet to come, and we're sinking deeper into a recession, or into a deeper recession. For those that are currently down since November/December 2020 and would like to play it safe, is he going to recommend that everyone copies him? But also don't want to lose profits, would you suggest to wait or just sell everything? I would certainly suggest to be patient at the moment. At the end of the day, I think it's incredibly unlikely that the market is going to drop by the same amount that it's dropped already, right? So, I mean, if you were going to sell, then you should have sold in, December. In hindsight, obviously. Selling now is a really pretty poor risk to reward trade to take, I think. At the end of the day, if you're sitting in cash, you're still losing out on 6, 7, 8% to inflation over the course of the year, perhaps more. Who knows? So holding it in cash isn't really a very good option. Bond markets are starting to improve a little bit, and private credit markets you can get a reasonable return where maybe you could match that, but most of us don't really have access to those markets. So again, that's not really an option for most people. So when you're looking at what's going to really recoup that loss the fastest, it's going to be equities, and it's probably going to be growth equities. So I think there's an argument for kind of being cautious on what you're picking, and really looking at especially the debt situation of companies and profitability. Um, but beyond that, if you're invested largely in companies that are profitable and have a positive balance sheet, then I think you're in a pretty healthy position to just hold on and hold out through the situation. Generally, dividend yielding stocks tend to do reasonably well during these kind of periods where markets are kind of uh, sort of bordering on on a proper full blown correction, or a bear market. Generally, dividend yielding stocks do tend to perform better, and so I think as long as you've got exposure to that, then you should be fine. And I think really then it's just about kind of timing your rotation to a heavier growth weighting when you think that the market is closer to a bottom. And I tend to agree. I think that there could well be some more downside to come. I think if there is, there's probably not loads. But looking at the charts at the moment, I think we're at a pretty healthy spot. We're back to on the Nasdaq. I can share my screen actually and show you this, I guess. Hopefully I shared the right one. Okay, so yeah, on looking at the Nasdaq here, Nasdaq 100, you can kind of see that we're back at the same prices that we first touched, all the way back in February of 2021. So a full year has been of growth has been wiped out already. And when you actually look at the earnings and the growth that these companies have had over that year, it's pretty meaningful, especially the FANG stocks, which make up the majority of this index anyway. And then it's the same kind of story on the S&P 500. Really, again, like bringing up the chart, you can see just how we're riding on this pretty key kind of base level here that goes all the way back into 2021, mid 2021, and this was actually pretty much when the real rotation into value kind of started, and people started to get more concerned about inflation for the S&P. So yes, like it could fall by like another 5-10% maybe. Like I haven't properly updated these, but if I kind of pull this down here, you can see like there's 7.5% down to this next fib level that I have drawn, which I don't know when I drew that actually. But that's that would take prices all the way back to February for the S&P 500, and the S&P 500's PE ratio and EV EBITDA ratio and all of that kind of stuff is looking pretty healthy at the moment. Like it's not that high. So I don't really see that much justification for it moving down that far. It could move down 7.5% more, and that would hurt because that's kind of compounding on top of the loss we've already had. That would be a big dead cat. But looking at that, like even here, you can see the amount of kind of volume at the price range below it. There's just a massive gap here, so it would be kind of filling that, and then you'd have all of this kind of buying pressure below it, kind of to push the price up. So it wouldn't surprise me even if we did come down and kind of touch somewhere around this kind of 4K level, that we bounce straight back up to like I don't know 4,150 or 4,200 or so. Anyway, but at the moment, and you can watch for those moves. As I said, like it is possible that happens, so we can watch for that move. Obviously I'm watching these levels pretty closely since we're riding right on it at the moment. But equally, we could just form a really nice tidy double bottom at this level. I'm not a TA kind of person, really, but like it's pretty clear that this has provided a lot of resistance, a lot of support for the price in the past. So it wouldn't shock me to see it do that, fill that role again for the S&P 500. And as I said, it's the same thing on the Nasdaq. Really, like you look down here, and it's it just doesn't seem that likely that it's really going to fall that far. If I put it on like a weekly candles, I don't know why I'm like doing full on and proper like looking at the charts here for some reason, but I think you get my point, right? I don't think it's really something that you should necessarily be expecting to play out. Certainly worth considering, and considering what's going to happen if it does do that, and I'm doing that, but I don't think it's a situation that really we should be kind of jumping into right now. For now, I think it's kind of wait and see how this week unfolds first, because a lot can change in a week. How do you see the tech sector performing this year? I think the tech sector is probably going to do pretty well by the end of the year, to be honest. In many ways, they're the most immune to a lot of these problems, especially the big tech side of things. You know, they have big balance sheets. They're generating an awful lot of money. They don't really have too many problems in terms of supply chain. There isn't really that much supply chain. Obviously, they have servers and things like that. They do have problems with retaining talent. The cost of developers is expensive at the moment, and we're seeing all of the big tech names kind of trying to increase their offerings and improve their working conditions and things to retain that talent. So that's going to hit the bottom line after they've kind of dished out for all of that. But the growth is still there in the markets that they're in. So I think they look pretty reasonable, and that they should do reasonably well this year, and probably. Well, it's hard to say if it's going to outperform the S&P 500 because they've obviously drawn down more at the start, and companies like Facebook are kind of dragging it a bit as well. But yeah, certainly some of them will do really, really well and provide some good returns. Why Visa and not Mastercard? That's actually a good question. I spent a lot of time deciding between Visa and Mastercard, and actually, I think trying to think back, I think in 2020, late 2020, I actually held a bit of Mastercard as well into early 2021. But then kind of closed it out and decided against it. For me, I just think I prefer Visa's, I guess, not so much management, but the kind of approach they're going for. I think that they were faster to kind of work through the blockchain and disruptive tech side of things, whether it's like, they're kind of their competitors like M-Pesa in Africa that they've got, or, like I think that they're just generally slightly more kind of tech orientated than Mastercard, and more kind of willing to take risks on newer technologies, and that's what I like about them. But ultimately, when you compare these two companies on any of the kind of big stock websites like Stockopedia or Seeking Alpha and things, there's not much to choose between them. So to some extent, it's kind of just personal preference. And for me, I think I prefer the management and the kind of the style of management that Visa opt for than what Mastercard have kind of gone down. But yeah, you can make an argument for both 100%. Like they're so similar in terms of the kind of valuations and what they're offering, and even the direction they're moving in is really similar as well. Another question from the same person. Do you think that the travel sector will do well? Will the war affect it? You have Airbnb in the portfolio. Are you reconsidering holding it? No, I'm not really reconsidering it. I think travel will still do completely fine, to be honest. There's a lot of talk about like this war, and I think kind of a tone that makes it sound like it's going to be a really hard fought thing. And to be honest, and maybe I'm naive on this, but from what the research I've done, I think there's a reason that Russia keeps kind of flaunting their nuclear capabilities, right? And I think the reason for that is that they know that if the US and Europe and NATO, the UK, or even just one of those gets involved, they can't win, really. Ukraine has massively grown its military. It's 10x'd its military since they took Crimea on their own. And I think the kind of civilian kind of rebellion against the invasion will also be, if there is an invasion, will also be very, very strong, to be honest. It really feels like Ukraine has kind of very much picked its side, in that they want to be aligned with Europe. And the company's made the country has made so much progress. It's such a shame to see this happening to them. But yeah, I think their military on their own, the Ukrainian military, if it wasn't, if there were no planes allowed in in this war, then I think that they might even be able to defend it on their own. Maybe not entirely, right? I'm sure they'd lose areas, but I think that they're not as weak as people are making them out to be. And if you then add in UK or European air support or US air support or even their military equipment, then it really does even things up very, very quickly. And if they kind of they all kind of back Ukraine, then I don't think Russia's actually got very much chance at all of invading successfully, and that's why they keep going back to this nuclear argument, I think. And of course the culture and propaganda war of saying that the separatists are kind of actually just part of Russia and it was never the Ukraine to begin with, and all of this kind of misinformation that they're throwing out there to try and confuse the message and make it sound like they're defending, not attacking. And that's for good reason, right? That Russia doesn't want a war. They can't afford to have a war. With sanctions, and then the fact that they would be fighting a force that's much more substantial if any of those other nations intervened, or NATO. It just doesn't make sense. So for that side of things, is travel going to be affected? I mean, it's going to be affected to Russia and it's going to be affected to the Ukraine, but those aren't the top two tourist destinations in the world. You've still got all of the Asian region traveling. You've still got all of the US open, and Canada and Mexico, and the majority of Europe will be unaffected. I'm sure that some of the neighboring countries will probably be affected. And I guess that people will be a bit more nervous, and maybe the economy will suffer a little bit and people won't want to travel because of that. But at the same time, we know that people are sitting on a lot of cash since a lot of savings, and there's this pent up demand to go and travel again. So I don't see it really being a major factor, to be honest. I'm planning to hold on to my Airbnb position. I also have Expedia as well. I bought them a bit ahead of their earnings, which went really well for them as well. So both of those have been doing pretty well. Both of them had really good earnings as well, and very strong outlook. And yeah, I don't see a reason to be getting out of that trade at the moment. Why don't you trade commodities, futures, ETFs, or invest in companies tied to them? Mining, extracting, processing. I've considered it. I've really considered some mining companies actually. It's like really considered it. An awful lot of research into a lot of the mining, are mining around copper and lithium and a few others as well, and cobalt even. But I think it was just a bit risky. A lot of the nations that are really kind of where these big mining operations are set up have been a bit more politically unstable, and a lot of them are also a lot closer to Russia. I mean, Ukraine is one of them, and I think it was Kazakhstan that had the big problems with uranium prices soaring because of the crisis that was going on there with energy and things. So like it's definitely an interesting market to look at, and the valuations for probably the past year or so have been really attractive there. But it's just something that I haven't actually gone into. But it's not that I'm not considering it. It's also not really an area of my expertise, and I think there's a lot of risk in essentially that you're betting on these mining companies timing the market in many ways in terms of their expansion and kind of contraction of mining operations, and stockpiling or just selling it as soon as they mine it. All of these companies do that kind of stuff, and it's putting a lot of trust in the management of those companies. But the valuations have been attractive enough to where I've considered it. But it's just not something that I'm doing at the moment. But I wouldn't rule out doing it in the future. Thanks for all the people subscribing, by the way. You don't have to, but it's pretty cool that you do. What is your view on UK and European markets this year and opportunities in them compared to the US? Well, before this Russia situation kind of unfolded, I thought the opportunities in both Europe and the US looked incredibly attractive. They've really been underperforming to a large degree for several years now. And there's a lot of big value kind of names, or it's a much more kind of value orientated market, and the rotation into value that we saw at the start of the year, I really thought would play out a bit more in European markets and UK markets than it did. UK markets are actually having a pretty good year so far because obviously they're very heavily weighted towards things like commodities. Commodities, whether that's fossil fuels like gas and oil, and refining companies and stuff like that, or mining as well. It's exposed to a lot of those things that are seeing rapid kind of growth of demand, or low supply. So yeah, the UK market I think will definitely do well this year. I think the European market as well should do well this year. I genuinely think that there's good value to be had there, but the Russia situation with Ukraine has definitely kind of muddied the waters a bit and made people a lot more nervous. A lot of those kind of names have operations either in the Ukraine or Russia, or in neighboring countries, or that kind of region. And even if not, like, a lot of the supply chain and stuff has been affected for these companies as well. So yeah, that's it, I guess. I mean, I think they're in realistically it should outperform the UK. I think should outperform what it normally does, and normally the UK is a bit slow, to be honest, in recent years. But I think it's probably in for one of its best years in a while. And European markets, it really, I guess it depends on how long this situation drags out. And of course, there's always the underlying concerns about inflation and interest rate hikes and stuff as well. But the fact that Europe, for example, hasn't really kind of pushed on interest rates at all yet, perhaps makes it more attractive to people. For certainly in terms of like credit markets and some of the growth opportunities there as well, or companies that are kind of a bit closer to turning to profitability but have quite high debt at the moment. Yeah. What kind of advice would you give to someone very young today, and which you wish you knew 10 years ago? Wow. Doesn't have to be related to the investing world. Thanks in advance. Oof. I mean, that's a good question. What advice would I give someone? I don't know really. I mean, like, if it's not related to investing, then I would say the most important thing, the most important skill generally, and it's also related to investing as well, I think, generally, that you can have in life is being good at information gathering and interpreting that information, that data. It's so important in today's world, and it's increasingly important in the world of fake news and conspiracy theories and information overload. All three of those things really kind of contribute to the need for people to be able to consume information very quickly and find information quickly, but also actually kind of examine it and come to your own conclusions about it, and look at counter arguments, and critical thinking skills, and like the ability to like kind of process information is like the most important thing that a young person can probably work on. And then I guess the other thing is like just kind of being aware of the trajectory that society's on, and the world is on. Where if you're really young at the moment, then by the time you're in your like 30s and 40s, obviously climate change will be playing a much bigger role in the world, and probably a lot of countries' priorities will change. We'll see probably shrinking populations in an awful lot of countries, and kind of mass immigration towards those countries, and the political uncertainty that's going to cause. We're going to see more automation of jobs. Like, there's so much going on in the future. Like, I feel like if you're a young person, it's worth like actually spending and investing a lot of time learning about all of these kind of trends, and really what the world's likely to look like when you're older, so that you can best kind of position yourself to, survive it all. To be honest, I think depending where you're born and what country you're in, and what your start is in life, then it can be a kind of dystopian future that we're looking at. And as a result, I think you've got to kind of prepare for it the best you can. It sounds sounds really down, but that's kind of the way I think about it, right? I think you have to look at the way everything's going, and think like, there's a lot of disruption basically. Like the world is increasing in innovation. Technology is always ramping upwards. Everything seems to be going more and more exponential. And when population growth slows, and we have a small population trying to look after an aging population, like there's so many challenges that kind of lie ahead, and the impact that will have on markets and growth is huge. We may see in 20, 30 years time, not so much the end of growth necessarily in terms of stock markets and things, and economies, but certainly I think it's going to slow down. And that's I guess that's the thing. So yeah, my advice: look to the future and try and plan ahead at least somewhat, or at least be aware of it. And the last guy, unfortunately, has had their stop loss kick in, and can't get back in. Yeah, there is no way of getting back in, I'm afraid. So if you're planning to copy, and as I said, like I really think that patience is the way to play this, not kind of panicking about how much money we're losing. I mean, like at the end of the day, my portfolio is down as well, right? Like if you're copying me, you're experiencing the same drawdown that I'm also experiencing with my own money, right? And if it draws down far enough, then my paycheck will also start decreasing. So trust me, I'm as motivated as anyone to make sure that we come out the other side of this in a good position. But I really do think that there is a big risk of kind of going overly bearish and missing out. At the end of the day, people have been calling bear markets since since I started investing, really. Like there was a brief period in like 2014, 2015 where nobody was really calling for bear markets, but ever since then they've been calling for it, and before then they were calling for it. So definitely not definitely not wise, I think, to be betting against all of these economies and all of these companies and the world generally benefiting from growth. Okay, so that's all of the questions from here done. I'm gonna kind of scroll up a bit in chat and see if there are any questions in here to answer. And if you've already asked a question, then you shouldn't have to type it again. Keep an eye on where you asked it in the chat, and I'll try and catch up. But let's see how we go. Okay. Elephant in the room. There is a political crisis affecting the markets. I feel like we have addressed that. Should I go all in on Peloton? I can't give you any personal advice. I got out of Peloton, and it's a painful one. It is a painful one, because I was pretty bullish on Peloton, but the management really did fail, and so I took out a lot of cash around here after this earnings report came out, and that was the real devastation, right? That was 50% loss in a day, more or less. And then I kind of reduced exposure a couple of times down here, and then I kind of bought the dip a little bit, like somewhere around here, and then kind of held on to that and thought I'm going to hold on to at least a small part of my position through until next earnings. But obviously you can see the day pretty clearly here, which is where they reported that they were going to miss earnings again, and that there could be changes ahead, and job cuts and things like that. And then the earnings came out, and they were also terrible. If you actually look here, you can see they were really, really bad. I mean, revenue was okay, I guess. I mean, like I say, really bad, right? Like they were in line with what they said that they were going to be here, but they were really bad as they said that they would be here, right? And the market priced that as down here, down at like $25 or so per share, right? That's what the market thought. The reason the price jumped here is because they said that they're changing the CEO and that they're cutting, they're going to give up on the new Peloton factory and cut kind of jobs and things like that. And we've had like a few little bits of good news here and there in the company since then, and like activist investors trying to get things changed and whatnot. But in reality, like as much as I love the product, I use the product, and I love the kind of vision, and I really do believe that they will be a profitable company in the long term, and that in the worst case scenario that they will get acquired. I don't think now's the time really to be buying. Probably, like I guess there's an argument to be made that maybe you could, but I think when you're in a market where everything's discounted, like going for something like this that's really far from profitable, I don't think it really makes too much sense. So, yeah, I'm not buying it. It's entirely up to you. Do your own research and such on if you want to. But it was a painful trade for me, definitely. Had a lot of exposure to it, a lot of conviction in the product and the strategy, but really management let it down for me. When do you expect an uptrend again? Do you think you can still close green by the end of the year? I do think I can close green by the end of the year, definitely. I think there's a lot of opportunities in crypto still. I think that is getting to some slightly better valuations, especially some of the slightly smaller projects. They're not really that many of them on eToro yet, but certainly I think there's definitely opportunities for growth there this year. I think again, like a lot of the kind of value stocks. I mean, Lowe's, for example. They reported their earnings today, and Home Depot did it a week earlier. The two of them basically have a duopoly on, home improvement in the US, and that kind of side of things, DIY. And both of them had really, really strong earnings. And there's more on the horizon. They're both doing, share buybacks and good dividend yields. Those investments look pretty good to just hold on to, and I think that realistically, they will continue performing well. I think there's good opportunity in tech. I think there's good opportunity in small caps if the market turns around in time by enough. The market will definitely turn around, I think, before then. Or maybe not definitely, but it's incredibly likely that the market's going to bottom out within the next month or so. And then start kind of moving higher. But the question is, how quickly and how far higher does it go, right? Does it erase the losses this year, or does it take a bit longer? So it's it's really hard to say if it will or not. But I think if you're in some of the really big growth plays, and if you kind of rotate towards them at the right time, then definitely you can benefit from that. And there's still so many other kind of situations going on in the world as well. Like I still really think that the solar industry and the renewables industry is just due a big boom when this turns around, because they had a pretty bad year in 2020, very bad year last year, and so far this year they've not had a great year, with the exception of a few names. And yet their guidance is strong, their revenue growth is strong. It's really just comes down to profitability and the price of the cost of money, I guess, to some extent for the debt and the commodity prices and semiconductor shortages and things like that. But when those situations turn around, I really think that those companies are going to boom, because they've just lost so much of their valuations. And I think that again, ESG investing is growing, and the demand for energy is growing. So yeah, I still think that sector is gonna, when it does bounce, is gonna be huge, and that might happen second half of this year. It might take longer because of the commodity side of things, or it might kind of be split. I think that solar is going to start recovering, especially household solar solar before wind does, in the West at least. So that could drive it as well. I think semiconductors look really, really great at the moment. I think a lot of the big tech and big kind of content names look really good. So Disney is looking pretty attractive. I think Netflix is looking a bit more attractive recently. Google, because they have YouTube, and obviously the rest of their companies doing really well. Microsoft's doing great on the gaming side of things. Sony is an attractive valuation. Like I see a lot of good valuations around the market, and it's hard to imagine those companies like growing at a rate that's so slow that they're not justifying the price going up, even against this macroeconomic backdrop. Yeah. And then there's there's EVs. Like there's so much going on. There's so much like potential, and like when you actually kind of think about it long term, like and that's what you need to do at the end of the day, right? It doesn't matter if I make a profit this year. I mean, it does. It's upsetting, right? We'd all love to make a profit every year, and we'd love for it to be a good profit. And as I said, I do still think that we will make profit this year. But if we don't, I'm not concerned. Like if you look at me, like I don't think I come across as panicking right now. Markets are down, Nasdaq's down like 15%, S&P's down like 10%, a bit more maybe, more than 10% now, I think. Yeah, I'm not remotely panicked. I look at the companies I'm invested in. I believe in all of them, pretty much. The only reason that you see me kind of swapping out of positions is because I'm kind of struggling to choose the best opportunities, to some extent, and shuffling money around, thinking, wow, this one's even better value, or this one's even better value, or this one fits better with the portfolio and risk and stuff. So yeah, like when you look at it 3 years down the line, like I'm so confident that all of these positions are going to be in a lot of profit and significantly outperform markets. That if we lose for another year, then so be it. If we close the year minus 2%, then so be it. It's not what I want. It's not what I'm trying to achieve. But I'm not going to be like really upset if that happens. Just a bit sad. And I hope you guys understand that, right? Like at the end of the day, I am a growth investor, growth orientated investor. I'm a thematic investor. I'm an ESG focused investor. And all of those things carry higher risk, and they carry their own correlations, right? I'm going to be more correlated with growth markets. I'm going to be more correlated with kind of renewables markets and things like that. And if those sectors do badly, I'm going to do badly. And depending on my kind of exposure and risk appetite at the time, I may do worse if the beta of what I'm investing in is higher and the market goes against me, or I might outperform them on the way down. But the point is that on the way up, I'm really confident that I'll outperform them. Again, like that's my opinion, and you kind of need to judge for yourself if that's the right kind of risk exposure for you, and how much you're willing to kind of put behind that methodology and that method, going into the macro environment that we're in, and considering if you're planning to get married or buy a house or whatever it is that you're planning to do in your own life. You have to figure out how much of your money are you willing to kind of put behind that idea, and that's up to you at the end of the day. If you're like 80 years old and you're retired and you're looking to just spend as much money and live your best life for the remainder of your life, then maybe I'm not the person for you, because I have a risk of losing some of that money, and that means you get to buy a less extravagant retirement for yourself. But if you're younger, then I think generally you're probably going to be able to weather these storms much better, and think more about the long-term kind of growth that you're looking for. Sorry, that was such a long answer. I don't even remember what the question was anymore. I've just been rambling. Oh, terrible. Where even was I? I don't even remember what question I was asked. Oh dear. Oh yeah, it's just if I was going to close green for the year, yeah. Considering markets are set to react to the rain situation, I assume that's a really strange typo for Ukraine. Impending interest rate rises from the Fed, so you think it makes sense to short sell companies? Yeah, I kind of already answered that. Not really, to be honest. I mean, it's hard to find. It's hard to find companies that are only exposed to the Ukraine or to Russia. And on the Ukrainian side of it, I'd feel pretty bad, to be honest, about shorting companies in Ukraine at a point where the country's potentially about to be invaded. Call me crazy, but that doesn't sit great with me ethically. So yeah, I'm not sure I'd do that. Maybe some of the Russian oil companies and gas companies, maybe I could short those, possibly. It might be a reasonable bet soon, actually, but I'm not sure. There's high risk associated with that as well. Because at the end of the day, those markets are doing well at the moment in terms of gas and oil prices and things. What's your view on main crypto, ETH, Bitcoin over the next 6 months? I think probably a bit more sideways-ish overall for that kind of time period would be my kind of estimate. I think there's still a really reasonable chance that Bitcoin goes below 37K. I still think Ethereum is, in the long term, one of the best bets that you can get right now. Because obviously of the ETH 2.0 and staking and the burn and everything else that's going on with it in terms of the kind of tokenomics, and then obviously the trajectory of just the sheer volume of developers and NFTs and everything else that's behind it, DeFi, that's kind of powering the kind of use case for that crypto, I guess, and utility for it. Yeah, so I think Ethereum is the one that I'm more bullish on, I guess. But there's arguments for Bitcoin as well. I kind of think there could be a clampdown on Bitcoin, though, because, Russia unbanning it and kind of favoring it a bit more, and it being used to send money to the truckers kind of protest in Canada, and obviously the climate side of things and the amount of power that it's using, the inefficiency. I do feel like the governments... a lot of governments are probably starting to feel more like they should kind of clamp down on it more. Maybe that'll be like a higher taxation rate for Bitcoin specifically or something. I'm not sure. It's really hard to say, but I feel like there's a kind of growing shift in sentiment towards Bitcoin, especially that governments and I think it's more because the kind of demographic of people that like Bitcoin that the governments are becoming uneasy about. And citizens as well. Can I have a question? It's able to following copy because some time ago you have full. Yes, I am still full. I'm very sorry. You still can't copy. Sorry. I'm in Ukraine at the moment. I think there is too much OTT fear. Yeah, I as I said, I still don't really think that an actual invasion is going to happen. I think Russia's going to continue playing this game of pretending that it's been theirs all along, and that it was never really the Ukraine to begin with, and that they're just defending it, and then kind of painting the US and Europe and everyone else as the aggressor. And, as a result, maybe not that much will really happen, and that there'll just be lots of sanctions for a while, and that the rest of the Ukraine will be somewhat safe. I mean, it's still pretty sucky to just lose a bit of your country like that, but I feel like actually that's probably one of the more likely outcomes, is that Ukraine just kind of takes a bit of that Donbass region, or not Ukraine, Russia takes a bit of the Donbass region as its own, essentially, through nothing else than just saying, actually, this is ours. And, kind of all the work that they've done in those separatist communities kind of paying dividends, I guess. All feels very clickbaity. Oh yeah, in terms of the headlights. How do you fund your day-to-day living? Do you have a strategy for taking profits? Well, my day-to-day living is funded by my salary from eToro. So I guess I'm pretty beneficial in that side of things. Pretty lucky on that side of things. I would say for 99.9% of people, you should not try and do trading full time as your job. You should do trading part time, and certainly do some research on the weekends and stuff, and run generally a kind of more long term portfolio as a result, because you won't have as much time, and you should have a job. And the reason for that is that you can compound your gains much quicker if you have a job and then just add your money from that job to your portfolio than if you were just living off your portfolio. I guess the kind of point at which that starts to change is when you get to, like, I don't know, $1 million or so of total portfolio value. When you get to that kind of size, then yeah, sure, you can live off it pretty comfortably. I say pretty comfortably. You'll probably be pretty stressed out when there's markets like this. So, I think, and also I think honestly, it's pretty boring for most people. Most people aren't like me. They don't just like Googling things all day about different industries and different companies, and listening to earnings calls, and, watching video essays about, the theme park industry or whatever it is. Most people don't like doing that all day, in reality. They're not interested enough, and they're more interested in their work, and their social life is better and everything else. So yeah, having a job is probably the best way to fund your life, not funding it from your investments until you get, a bit older, or, have kids or whatever, and have enough money to really justify it. Sorry, I know that's kind of shattering some dreams of what do they call it? Passive income. But nothing's really passive. Even your portfolio needs management. Arrived right on time for my question. Awesome. I hope I answered it well, because that was obviously earlier, and I'm just trying to catch up with chat. Jay, for your choice, stay away from fossil fuel, tobacco, military gambling, related stocks. Let's make this a better world. Awesome. Glad that you are aligned. Can you please give a brief rundown of differences between TRIG and INRG? INRG is one of the ETFs, is it not? Where shall I look this up? RG. Yeah, clean energy. Clean energy. Yeah, I thought so. iShares Clean Energy. Yeah, there's a massive difference. Trig is literally a holding company that sits on assets. They are a company that have very few member of staffs and very, very small overheads, that essentially own a bunch of wind farms, solar farms, a bit of hydro, a bit of battery storage, I think, now. And they basically own those facilities, and they essentially either directly contract in companies to manage it. They kind of have this other like branch within the company that does managerial stuff as well. So, but they either contract other people in to manage it and then, sell that energy that is produced from them to the grid, or they kind of lease out the sites to someone else, essentially. And yeah, they generate an income. So they have contracts either directly or indirectly, as I said, to the different energy companies that provide me and you with electricity. They have contracts with them for what prices they're going to give or offer, for like 80% or so, and then the rest is kind of like roughly free floating at the current valuations. And yeah, that's all they do, really. They manage that situation. Most of their facilities are reasonably old now, like 2012, 2015 kind of time is when most of the solar and stuff that they have and wind was built. There's some new ones that they've kind of acquired that are being built at the moment or are due to start construction soon. And yeah, they basically sit on those, and they earn revenue, and they have such small overheads that they just pay out a big dividend to anyone that invests in them. So yeah, it's not an ETF. It's a company that I guess acts kind of more like a fund, really, in that they just own a bunch of assets, and so because they have such little overheads and such small kind of costs associated, the valuation really doesn't change that much. The valuation is pretty much purely based on how much money their assets are worth. So the volatility of the asset is really, really low. So it's a good thing to just hold on to during markets like this, because it goes down by like 2% when everything else goes down by 10%. And they pay out a dividend, every year in the range of like 10% or so. So that's where your kind of return comes. The downside for that, of course, is that it's not from capital growth, so it's not capital gains tax. It's income or dividend tax, or depends on your country, I guess. But having dividend income is often not quite as nice. It would be kind of nice to see them do share buybacks, to be honest, to some extent. But yeah, that's that's the difference. Would inflation for USD or Euro as well? I'm assuming that was related to something I was saying earlier, but it doesn't seem to make much sense in the current context, so I guess I'm going to ignore it. Someone shorting USD ruble today, 10x. Ouch. Wow. How does it impact now that you don't buy the underlying assets? If you're an investor out of USA applied to ETF, do we still receive dividends? That's a confusingly phrased question. How does it impact now that you don't buy underlying assets if you are an investor out of the USA applied to the ETFs? Okay. It doesn't really. It's a CFD, and at the end of the day, a CFD is a contract for difference, which means that it's a contract for the difference in the value of the asset and how much it's gone up or down, plus, minus dividends or fees or whatever. So sometimes it means that your dividends and things like that will be a bit late in some cases, or different. But yeah, essentially the price is pegged to it effectively, so it shouldn't really be a problem. The price should be the same. The only thing that could change maybe in some countries is taxation, depending on how legal it is in different areas. But that's really it. The only reason, of course, that they can't offer the underlying ETFs is that they don't produce the key information documents, the KIDs, which EU, the EU, like MiFID II, I think it was MiFID II, law basically requires for EU citizens to invest, and the UK basically copy pasted those rules when we did Brexit. So same in the UK. As far as I'm aware, it might have changed by now. Don't take my word for it. Do you think we're bottoming at the moment? Possibly. As I said, like we're within a kind of we're within like the 1 month window of the bottom, I think. That means we could be right at the very bottom, like today or yesterday, or we could be at the bottom in a week, or we could be at the bottom in 30 days. But beyond that, I think it's unlikely that the market would go lower. So we're close to bottom, I think, which means that it's probably not worth shorting or hedging too much, in my opinion. Where would someone begin to get involved in investing and work through their knowledge to your kind of level? That's a good question. I think the first thing to do is to start investing before you even start learning. Sounds absolutely crazy. Who would give such ludicrous suggestions? Again, like this is not it's not financial advice. Like, don't gamble all your money. When I say start, I don't necessarily mean start managing your own money like that, and investing directly yourself necessarily. I mean, start pretending to, do paper trades, do some research into a company, and decide if you like it and if you think it's going to go up, and write down how much you would invest of your portfolio if you were to, and then at what price you would want to sell, or what kind of event would make you likely to sell, or whatever, or how often you want to check back on it or something, and then kind of watch and see how that unfolds. That's a good way of starting, because you'll learn more about the kind of psychology of investing, and the weighting of different investments within a portfolio. if you do that, and hopefully you'll learn more about research. In terms of like where to learn research stuff, Investopedia is by far the best place to start if you are like brand new to this and you're hearing loads of terminology and you have no idea what any of it means. Literally just type in the terminology, the word that you've heard. Like it could be someone talking about an indicator for technical analysis, or even the word indicator or the phrase technical analysis, right? You can literally type those into Investopedia and it will tell you exactly what it is. It will give you examples, and you can kind of dive down the rabbit hole from there. The same with all the fundamental side of things. If there's a ratio that people keep talking about, like a price to book ratio, or if you don't really understand what the difference is between net income and I don't know, like gross profit or whatever, you can search those on Investopedia. Like this is how I started. I don't think I was really using Investopedia back then, but essentially I was doing that, right? I was Googling like, well, what's the difference between this and this, and how do you calculate this thing? And that's how I started. And it's how I've kind of it's the same way I've answered this question for years, is to basically Google things you don't know until you learn them. For the start at least. And then after that, when you start getting a bit more into it, you can look at, maybe paying for one of the good kind of fundamental research tools or technical analysis tools. They're not unaffordably expensive. Something, so like my preference would be Seeking Alpha and TradingView, but there's lots of them out there that are all different and display things in different ways that can be more friendly to you. Yeah, so those are the kind of things that you should consider for starting to get involved. And then after that, start looking at learning from some of the proper bodies that are actually teaching this stuff. The courses and the books aren't that expensive in reality. I just did the CISI Level 4 investment management course last year. Finished that in the second half of last year, and yeah, it took a bit of time and it was a lot of reading, and some of it is more useful than other bits, but it's great, like fundamental kind of base to learn from. And I think the level 3 course of that is really pretty accessible for anyone really to learn and complete if you spend time on it, even if you're starting from kind of nowhere. What was your growth case for Union Pacific? Do you think Tesla full self-driving could affect things? No, I don't really. So there's two things to kind of address here, right? So growth for Union Pacific, I think, they obviously kind of command the whole like east to west kind of routes in the US, pretty much, because the likes of CSX and KSU are doing kind of more on the east coast of the US, and don't really do anything on the west coast, and are much more focused on that side, which is a good thing, right? Because it's a really densely populated area, so the routes are shorter, the amount of track you have to maintain is less, it's easier to electrify it. All of those things are obviously benefits for them, but they can't do east to west, and someone needs to do it. And Union Pacific basically have a monopoly on that, pretty much. They also have a lot of the routes that go down and connect to Mexico, which is increasingly doing a lot of production of cars and raw materials and things that are actually heading back up into the US. So a lot of the auto companies have got factories down there and such. The amount of cargo and things you can fit on a train is obviously much more significant than what you can fit on trucks. The amount of staff that you need to run a railway is much less than you need to transport the same amount of goods using trucks, even if you are using full self-driving, even if you assume that there's nobody in well, maybe not if there's nobody in the cab, but realistically there's going to be people in the cab for a pretty long time to come yet. And of course, the other thing is that trains are also developing full self-driving technologies. Trains are also increasingly becoming automated and technical. Trains are also electric already. in the majority, especially in Europe, the majority of cases, they're already electric. You look at Switzerland and Germany and Central Europe. I mean, their trains are incredible. I'd love to invest in them, but they're all publicly owned. Damn it. Which yeah, so there's all sorts of good cases to be investing in railways over trucks, but yeah, I think labor cost is one of the big ones. Rolling resistance, like a train is always going to be more efficient than uh, uh, anything that drives on a road because it has less rolling resistance. There's going to be less wind resistance because it's a really long train and whatever. A lot of the time the routes are, actually more direct. They go through a tunnel. They don't go up and down over the hills. They don't, they don't tend to do that too much because gradients and rolling resistance don't mix that well. Yeah, so all of that is a good reason to be long on railways. And I guess the last thing is the green credentials of it, right? Like, I mean, at the end of the day, the Tesla truck has been delayed by 4 years now, 3 years, I can't remember, a long time. Still no sign of it coming out at the moment. There is increasingly a lot of hydrogen trucks hitting the market, and BYD and a few other companies in China are making some good progress, and we're seeing Arrival and again BYD and Geely making some progress on like buses and some other large vehicles. But when you then consider adding a lot of weight to it, nothing beats a train at the end of the day. And again, like, trains can use batteries too. One of the companies I'm investing in, Wabtec, literally have a locomotive that has essentially been refitted to just be a full-on massive bank of batteries, and it recharges when you go downhill, just like a car does, and it essentially boosts the performance of the train when you're going uphill. And it's compatible with current diesel trains, for example, as well as electric trains. So yeah, all of these things are good reasons to be bullish on railways. Not to mention high-speed rail and passenger travel and stuff, and speed generally. It's faster than freight trains can go faster than road vehicles. Where would someone begin to get involved? I've read that one already. I'm losing where I am. Did I skip to the tester? Where even is the tester question? Oh no, that's where. Can you provide your views about the tech companies in regards to the announced 5 rate increases? Announced 5 rate increase. Is it not a risk for techs to fall? Second question, would releasing equity be wise now? Times like this, I assume we need to be careful with the money/stock ratio. You would think so, but inflation at these levels makes it kind of not the case. Like, usually in markets like this, yeah, you would definitely be more tempted to move towards cash. But because inflation is so high, and because inflation is ultimately, one of the driving factors behind the interest rates in the first place, cash really isn't a good option either. In terms of tech companies, again, like, it all depends on the balance sheet and cash flow. If they're a profitable company, and the valuation is not ludicrous, then it's perfectly valid to just hold on to that. If growth is still there, if there's good market opportunities for them to expand their product or services, which for the likes of Microsoft and Google and things, there is. It's almost limitless. It seems. I mean, even to the point where if there is someone else doing something really cool, then they just acquire them. I mean, that's what Facebook did for years. So yeah, it's kind of my opinion on it, I guess. There is a question in Spanish, and I do not read Spanish. Something about Mexico. Yeah, sorry, I don't read Spanish, I'm afraid. If anyone wants to find it and translate it, then you're welcome to. Oh, maybe that's what that is below. Yeah. Oh, maybe not. Maybe not. Any advice on how to upload my copiers? Upload your copiers? I don't know what you mean by that. Thanks for the stream and great info. Appreciate your work. For a copy of your account, stop loss set to 50%, and I'm totally fine with the current market situation, but don't want to hit 50% stop loss. What do you think? I think a 50% stop loss would be a pretty disastrous year to me, to be completely honest. So, yeah, I don't think you're too likely to hit it, but you know, I mean, keep an eye on where things are, especially if, like, I think, I'm not 100% sure, but I think if, like, you're adding or removing funds, then it can change your stop loss. So, you know, if any of you are watching and you're not sure, just double check what it is and where it is, and that you're actually happy with that. Like, remember, I think especially for the people that have a slightly higher stop loss, it's worth really thinking about, you know, do you really want to be stopped out at this level, or, you know, are you so far in now that you would rather just wait? You know, that's a decision that only you can make individually. I can't really help any of you make that decision. You know, I don't know what your risk tolerances are and how desperate you are to protect your money or whatever, what your time horizon is. But again, like, generally speaking, it's not wise to be investing in me unless you are really thinking about long-term investing. So, you know, with that in mind, you've got to consider the fact that I'm copy blocked, and if you do get stopped out, you won't be able to copy me again unless something reasonably dramatic changes at eToro. So I'm not trying to, like, scare anyone into staying with me or anything like that. Like, it's entirely up to you. You need to make up your own mind, but I just want to make sure that you're all kind of aware of the risks of stop losses generally. Hi, Chris, by the way. I cannot heard ads. I don't think I have ads turned on, so I don't know how you got ads. Maybe Twitch just plays ads on their own. Thanks for answering my question. Appreciated. How does trig compare to that? Yeah, I already answered that. Cool. I think we're done. Unless there's any, I'm gonna refresh. Refresh eToro again quickly, just in case there's anything new on here. Because why not? I've got a bit. Normally, I try and keep these to within 2 hours, and we're kind of approaching that, but we've got a little bit left. Yeah, no new questions. So, yeah, unless there's any more questions in chat. Twitch has been playing ads once near start and just now. Oh, that's really very unfortunate. I hope it doesn't do that when I take the video off. If you know which question was missed by the ads, I guess it's probably going to be ads at different times to different people, though. Yeah, probably the best option in that case is to go and rewatch on YouTube once I've uploaded it. It should be up tomorrow. I say that, last time I had all sorts of problems with, like, corruption and things, so maybe it won't be. Yeah, I uploaded it and it corrupted, and then I uploaded it and edited it, and then the edit failed, and then I had to edit it again, and it takes hours. So, yeah, hopefully this time it goes smoothly, and it should be up tomorrow. I think that's it then, because I'm not seeing any more questions in chat or anything. So yeah, thanks everyone for tuning in again. Really appreciate it, and thanks for copying. Please be very careful on social media, especially Instagram, of scammers. There was another new scam account created a couple of days ago called Jaynemesis with 2 N's, and I think that's now been blocked. But it's pretty much relentless. You know, every time one gets blocked, they create another one with another different variation of spelling my name and try and scam people. So be very, very careful. My name on all social media is Jaynemesis. As you can see from the things down the bottom, yeah, that's where you can find me. If you haven't joined the Discord, then please do. It's a cool community on there. They talk far too much for me to keep up with at this point, but If you have any questions you want to ask, or if you want to chat with other community members about who else they copy on eToro and things, then you can do that. Yeah, it's a good place to hang out. I think that'll do then. Thanks for watching, everyone, and I will see you again for my Q1 update and then Q1 Q&A. I do these every quarter, so you can tune in then. Thanks, and I will see you guys next time.